Hi everyone, if you're new to my channel, welcome to In the Money Options Trading and Education. Otherwise, welcome back to the channel, and I'm happy to have you back. This is the 6th video of the channel, and today's topic comes from a subscriber. Before we get deeper into options, it's important to have more foundational content so that I can meet my goal of having a self-contained library, and in order to contextualize options in the broader financial markets. This will also show why I focus on options and not on other types of derivatives like futures, forwards, and swaps. We have to start with a fundamental question. What is a derivative? A derivative is a financial instrument whose value is linked to an underlying asset, a group of assets, or a reference rate. Underlying assets and reference rates can include stocks, stock indices, bonds, commodities, foreign exchange currencies, interest rates, and could even include other derivatives. Derivatives in the financial markets typically involve at least two parties. The parties can trade in the exchange-traded market or in the over-the-counter OTC market. Typically, as retail traders, we are only concerned with the exchange-traded market, but larger derivatives players, such as banks and hedge funds, often transact in the OTC market, and it's important to know how they work. As the name suggests, derivatives derive their price from movements in the underlying asset. So, why would anyone want to trade derivatives? Wouldn't it be easier to simply trade in the underlying asset? Derivatives have several benefits that the underlying assets don't have. Derivatives can give us access to markets that would normally be inaccessible, such as the commodity markets. A retail investor would not realistically be able to trade crude oil or electricity if it were not for derivatives. Derivatives can also be used to transfer risk between parties, meaning they can be used to either mitigate risk, also known as hedging, or to assume risk, also known as speculation. There is another use of derivatives called arbitrage, which will be covered in a later video. The party for whom risk decreases as a result of using derivatives is said to be risk-averse, while the party for whom risk increases as a result of using derivatives is said to be risk-seeking. Retail option traders would generally fall under the speculation category, even if we are taking high-probability trades. Another common use of derivatives is leverage. Essentially, you are borrowing from the broker and able to take larger positions in the underlying asset than your initial cash outlay. This amplifies returns, but also amplifies the risks. We've only talked about options so far in this channel, but another broad categorization of derivatives is the so-called lock products, such as swaps, futures, or forwards. These products have no embedded optionality, meaning both sides to the contract are obligated to do something on or before expiration. We'll go into each product in later videos. The size of the derivatives market is truly astounding, with notional amounts larger than the world's GDP by almost a factor of 10. Due to the systemic risk of a collapse in the derivatives market, there has been a push to move OTC derivatives onto exchanges to reduce counterparty credit risk. We'll have much more to say about that later. The idea of derivatives is not new. Humans have always feared the idea of economic risk and ruin, which likely gave way to the first derivatives. Contracts involving the exchange of olives existed in ancient Greece. During the 19th century, the derivatives market as we know it began to take shape when American farmers helped create the Chicago Board of Trade. Derivatives played a key role in the 2007 to 2009 Great Financial Crisis. Financial regulation, particularly over the last 20 years, has been squarely focused on derivatives. Today, retail traders are a large component of the daily volume in derivatives. The emergence of many contracts has allowed traders with small account balances to get exposure to the derivatives market in a way that was not possible just a few years ago. Sometimes trading in the derivatives market has knock-on effects on the underlying asset, for example, gamma squeezes, which we'll discuss later. There will be many more videos that focus on specific aspects of the derivatives market, so I only wanted to give a brief touch in today's video. If you enjoyed this content, please subscribe and leave a comment for how we can improve these videos.